As individuals approach retirement, they start planning out what their income picture is going to look like. And it's important to understand there's actually 5 tax-free income streams that retirees can access to essentially lower their overall tax liability, lower the Medicare premiums they may pay, which are income-based, and stretch out the use of their assets to help hedge inflation and potentially leave more inheritance for their heirs. The first tax-free income stream are Roth IRA distributions. So if you have Roth IRAs and you're over the age of 59 and a half, and that Roth IRA has been in existence for more than 5 years, you can take withdrawals from that Roth IRA and you don't pay any tax on the contributions or the appreciation. Sometimes retirees will use distribution strategies from a Roth IRA when big unexpected expenses come up in retirement, and the only other asset pool they can draw from are pre-tax retirement accounts like traditional IRAs, 401ks, that if you take big distribution from those sources, it increases the annual income for the year, which can put you in higher brackets, raise Medicare premiums, lose certain tax deductions and tax credits. So sometimes being able to take distributions from those Roth IRAs give those retirees access to large tax-free sums of money. Many retirees are now processing Roth conversions to take advantage of their low tax rate during the retirement year. So with a Roth conversion, you're pushing money directly from your traditional IRA over to your Roth IRA. It creates a tax event, but if you're in a relatively low bracket, you're paying very low tax, and it's achieving 2 things. First, as soon as you push that money to that Roth IRA, all the future appreciation within that account can be withdrawn tax-free versus if it stays in the traditional IRA, you have to pay tax when you take that money out. Number 2, traditional IRAs are subject to what's called a RMD, or required minimum distribution, at age 73 or 75, depending on your date of birth. Roth IRAs do not have RMD requirements. You can continue to accumulate those monies into the future. The second tax-free income source are HSA accounts, or health savings accounts. So if you were covered by a high deductible health plan through your employer during the working years, it made you eligible to contribute to an HSA, and they're one of the most valuable accounts because it's the only type of account that you don't pay tax on the way in, you get tax-deferred accumulation, and you don't pay any tax on the distribution. Roth IRAs, traditional IRAs, any other source, you're paying tax somewhere along those lines. Where with HSA accounts, tax deduction on the front end, all the growth, as long as you take distributions for qualified medical expenses, no taxes on those disbursements in the retirement years. It's for this reason that we will often counsel clients to say, hey, if you can max out your HSA contributions during the working years and not spend that HSA account and just pay your health expenses out of pocket, we can start to build this big health nest egg that can be used to pay Medicare supplemental premiums, any out-of-pocket costs for medical expenses that happen in the retirement years, and the retirement dollars are huge that are needed to cover those medical costs, especially if you retire at age 65 and you live for 25 years, those HSA accounts can be insanely valuable. The third income stream that could potentially be tax-free in retirement is Social Security. Now, I say potentially because the proportion of your Social Security that's subject to tax depends on your overall income. And there's essentially 3 tiers. There's 0% tax, where Social Security is 100% tax-free, 50% of it's taxable, and then 85% of it's taxable. This matters because if a retiree can structure their distribution strategy correctly, they could show very little income outside of the Social Security benefit they're receiving. Now, half of the Social Security benefit counts towards this formula of saying, is it 0, 50, or 85% taxable? But if there's very little income outside of Social Security, these retirees might be able to get their Social Security completely tax-free, where otherwise they might have to pay federal tax on 85% of the Social Security benefit that they receive. The fourth tax-free income source is municipal bond interest. So for retirees that are still in relatively high tax brackets, and I stress relatively high brackets, because sometimes we'll see retirees make the mistake that, yeah, they were in high tax brackets in the working years, but they went to retire and now they're in a low bracket and they're still holding on to municipal bonds. And our first question is usually like, why? It made sense when you were in a high bracket, but holding municipal bonds may not make sense where now you're in a lower bracket. But this strategy is more for the retirees that are still in a high bracket in retirement. Municipal bond interest is usually tax-free at the federal level. And if you're buying muni bonds in your state, it could also be tax-free at the state level as well. One of the tax strategies that these retirees in higher brackets may implement is holding municipal bonds in their taxable accounts, but then holding the higher yielding corporate bonds and whatnot within their IRAs and 401k and tax-deferred accounts. The fifth tax-free income stream is a return of principal or cost basis from a taxable brokerage account. So if you have a taxable brokerage account, you can be selective as to what you buy and sell, that if you sell something that hasn't created a large capital gain or hasn't had large appreciation, you might be able to take withdrawals from that account with relatively little to no tax on those distributions and avoid selling the holdings that have appreciated a lot in value that can then generate long-term and short-term capital gains, where it may be better to let those gains continue to ride because your heirs may inherit them and receive a step up in cost basis when it comes to these brokerage accounts. While many retirees focus largely on the rate of return of their portfolio, many neglect the benefits of having a well-crafted distribution plan, looking at all their different assets, whether it's pre-tax, Roth, Social Security, pension plans, to really devise a good distribution strategy to help minimize the tax liability over their lifetime, and then considering the tax liability for the next generation through Roth conversions, step up in cost basis, trusts, and other tax strategies. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.